Almost every single person asks me this question. What are the rates like right now? But I would put money that almost no one understands what they're even asking me. Because that question on its own, it kind of makes no sense. Mortgage rates aren't fixed numbers, they're menus. And every menu changes depending on you, your credit, your loan type, your timeline, your goals. So when someone says, what's the rate? They usually mean, what's the rate for someone like me on a home like that with terms like these? Which is a completely different question. Actually, it's 3 questions. Now, yes, there is an average 30-year fixed rate, and that's published every single day, but that's a generic index. That's not your rate. That's like asking, what's the price for a flight? Well, it depends. Where are you going? Are you going first class or economy? Check bags, round trip? This same logic, it applies to mortgages. You don't just get a rate. You pick one, whether you know it or not. That decision, it happens when you buy points, take a lender credit, or stay at the par rate. And the rate you qualify for also depends on the type of loan, the property type, your income, and your goals. So again, the question isn't what's the rate? It's what are my options and what trade-offs make the most sense for me? Because here's something that most people don't quite understand. Mortgage rates aren't static. They live on a sliding scale, and you're the one who chooses where to land. You don't get offered a mortgage rate. You pick one. You just might not realize that you're picking. Here's how it works. There's something called a par rate. That's the neutral rate for the loan. No discount, no bonus. It's just the clean version of the loan. Now, if you want a lower rate, you can buy points. Most people have heard of this. This means that you pay more upfront and reduce your interest rate for the life of the loan. So it's a trade-off. More cash now for lower payments later. But buying points only makes sense if you're keeping that loan long enough to recoup the costs. And really, most people don't. On average, people move or refinance every 7 to 10 years. So if you refinance early or sell your home, you don't get the full benefit of buying points. That money is gone. On the other side of the scale is lender credit. If you're short on cash at closing, you can agree to a slightly higher rate. In exchange, the lender gives you money back to help cover costs. That's called lender credit. But that higher rate means a higher monthly payment, which can also increase your debt to income ratio. And if your DTI gets too high, the loan might not even qualify. I didn't mean to turn this into a rap song. I'm not a rapper. So you're not just choosing a rate, you're choosing a cost structure. And what most people miss is this. The whole sliding scale, it changes again based on the type of loan you're using. 2 people with the same credit score, same income, same down payment can get completely different rates just because of the loan type. Let's break it down. Conventional loans are the standard, but even within conventional, there's layers. First-time home buyers often get better pricing. And yes, conventional loans actually allow for lower down payments than FHA. The benefit there is that there's fewer long-term fees as well. And what's crazy is that a lot of banks and brokers will default to FHA. Why? Because it's easier for them to get it approved and process the file. Not necessarily because it's better for you, the borrower. And that default often costs you a lot over time. Now, FHA loans, they do have their place, don't get me wrong. The biggest strength is its flexibility, especially when it comes to debt to income ratio. Some FHA loans allow DTI up to 57%, which is massive. This can make the difference between qualifying and getting denied for a lot of people. Now, we have VA loans. Obviously, this is only eligible for veterans, but what's cool here is that it allows for 100% financing. So that means 0 down payment, plus no monthly mortgage insurance. It's one of the best products available if you qualify. Now, there's also USDA loans. This also allows for 100% financing, so no down payment required, but they're only available for properties in eligible rural or suburban areas. And their income limits are based on household size. Next up, we have bank statement loans. These are for the self-employed borrowers who don't show income in the traditional way, making it a higher risk loan for the lender. DSCR loans. These are for investors. The rate and terms are not based on your personal income or finances. It's based on the income and cash flow of the property. These carry some of the highest rates on the market, but they're flexible, fast to close, and you can close under an LLC. So with all that being said, the type of loan that you're using, it changes the entire pricing menu. But even if you pick the perfect rate today, what happens if rates drop later? Even if rates drop by 1%, refinancing might still be a bad idea. Here's why. Let's say rates drop and you think about refinancing. Yes, you could get a lower rate, but understand refinancing is not free. You now have new closing costs. And just like buying points, it takes time to break even on those costs. That's why you don't just look at the rate, you have to run the math. Also, sometimes it makes sense to take another lender credit on the refinance, especially if rates dropped enough to build that margin in the pricing. That credit might wipe out most or even all of your closing costs, but probably just most. If you've built a lot of equity, you might not even need to bring cash to closing at all. You can roll those costs into the loan. Here's a really important point. If you're doing a cash out refinance, something that a lot of people don't understand, the money you pull out, it's tax-free because it's debt. Technically, it's not income. That's how a lot of investors scale. Now, real quick, it's important to note that FHA has streamlined refinance options, so no appraisal, limited documentation. VA, USDA, they also have similar streamlined programs. This is extremely beneficial for those who just want a rate and term refi without the hassle. So, if picking a rate is a trade-off and refinancing is a second chance to restructure that trade-off, how do you actually choose the right option the first time? There is no such thing as the best rate. There's only the one that fits your timeline. Choosing a rate comes down to one thing. When do you want to pay? If you have extra cash now and plan to stay in the home long term, buying points, it actually might make sense. If you're short on cash and need help with the closing costs, taking a lender credit could make the deal work. If you're planning to refinance soon, buying points probably doesn't make sense. If your job or lifestyle is flexible and you might move in the next few years, you need flexibility, not the lowest possible rate. There is no one-size-fits-all answer here. What matters is knowing the trade-offs and choosing it on purpose, because every rate is a trade. Less now, more later, more now, less later. The mistake is thinking that you don't actually have a choice when you do.